Good afternoon. Welcome to today's webinar. Today's webinar is an ad hoc webinar where I just thought I'd take this opportunity to let clients know my sort of view and opinion as to where the market, the share market is today, and where I anticipate it's going to head in the future. Received a few phone calls from clients just asking for my feedback. Some of those people have been certain, others are less so, just with the noise in the market and the media as to what is going on with the market. That noise is creating a lot of uncertainty for a few people, and I wanted to go through why we implemented the JB Way as an investment strategy that overcomes a lot of that fear that usually arises from uncertainty. If you do have any questions, then please put it into the questions section on the go to meeting section, and I'll look at addressing them throughout the presentation. If I do fail to see it, I'll certainly address it at the end. So just covering the disclaimer, look, it's been produced by the SMSF Club. We're a corporate authorised rep of an Australian financial service licensee called RM Capital. As an individual, I am also licensed, so I'm licensed to be able to provide you financial advice and give opinion about different asset classes. Today, and likewise, the majority of the stuff that the SMSF Club deliver is what's called general advice. What general advice is education. I obviously haven't taken into consideration your personal needs or objectives when putting together this presentation. So I encourage everyone to speak to their SMSF advisor or to seek professional advice with the information obtained. Let's go through it. Look, as a company, our mission statement is to free people financially to live the life they want in retirement. And why I wanted to speak about our mission and our job as advisors that we take on board with a lot of respect that you've shared that responsibility with us to help guide you to hopefully reach your retirement goals, if not exceed them. So I want to give that mission statement because that's very different where the majority of Australians actually receive the information that they use to make investment decisions. Unfortunately for most people base their information when it comes to making an investment decision based on the information they read in newspapers. Or newspaper is probably an old term now. If you're not reading it in the newspaper, you're certainly looking at it online through news channels. Now, Sydney Morning Herald, Fairfax, you look at the Australian Financial Review, the Daily Telegraph, or the Courier Mail, whatever the financial journal that you're reading, their job is not to free you financially, right? Their job is merely to sell more newspapers. And unfortunately, what sells more newspapers is bad news, not good news. So generally, in these times of uncertain behaviour, they magnify that level of uncertainty. They magnify the level of fear simply by coming out with huge headlines that sells more papers, but doesn't necessarily make you more money. So I want to address some of the headlines that I've seen over the last few days, last week. Didn't take me long to find a few negative headlines, all of a few minutes. Just to highlight what is noise in the market and try to decipher the difference between noise and what is actually factual. Because what we need to base our information isn't on the noise in the marketplace or uncertainty, but more on the facts, and that's what I want to address today. Let's look at some of that market noise. Now, Sydney Morning Herald, ASX suffers worst day of the year amid renewed oil rout. Over $30 billion was wiped off the share market on Wednesday in one of the biggest falls of the year, as a sharp dive in oil prices over the past 2 days shattered investor confidence and sparked a broad-based sell-off. That was the Sydney Morning Herald. The Australian Business Review, Wall Street tumbles on Fed. Again, some issues in the Fed as to what they're going to be doing in the United States with regard to interest rates. The bears are in charge of the Australian share market. ASX, Australian shares fall by 36 billion in global slump. Lost 36 billion following steep falls on Wall Street and across Europe. The benchmark ASX 200 was down 2.4%. Let's go a little bit further. Stock market crash. This chart shows big losses ahead for equities. If you are bullish on equities, it may be time to pause and reflect. We could be headed for a stock market crash. Japanese stock market plunges 5% as global rout gathers pace. So if you look at these headlines, you look at the newspapers, right? They're very quick to grab broad-based statements. But when you read these headlines, it's not the time to hit the sell button in a frenzied panic, which a lot of investors make the big mistake in doing. What we need to do is look at what is factual, how it relates to maybe the portfolio and investment strategy you've adopted as an SMSF trustee, and then look at, well, rather than looking at the problems, let's look at whether or not any opportunities exist during these times. Ticking time bomb. That's talking about the Chinese share market and Chinese economy. Financial panic. China's stock market hits again as fears grow for global crash. All of these headlines give me a lot of confidence, but what it does take is a lot of confidence to come up with bold predictions as to what the future holds. If anyone does that, they'll just be guessing. Now, I'm not here to say that the share market is going to go up. I'm not here to say that I know what the economy is going to do in the future, because in all times, the economy faces hurdles. It faces uncertainty. It faces issues that need to be addressed. Every day, our economy faces those problems. What the share market does, though, it gives the media a measuring stick to come out with headlines and to sell more newspapers. So remember that these issues have plagued our market forever. What enables markets to go up in the future is not what happened yesterday, but it's what's going to happen in the future. And that's what we need to focus on. While the future looks pretty bleak, in that it's uncertain across the globe with China slowing, or albeit at a slowing pace, it's still 7% GDP growth expected, which is well above the majority of the world. We have the US economy with the Fed raising interest rates for the first time since the GFC just recently. So with that further uncertainty, it's like, how's that going to impact equity markets? And I don't know the answers to those questions. What I do know, though, is irrespective of what happens, we need to look around and look at fundamental, strong companies that are not really witnessed or exposed to these markets. And that's what I want to address today. Is during this uncertainty, as one of the articles mentioned before, as it's dragged down the entire market, we're to look for quality stocks that have been hit and hit hard. Here domestically, what we've had Dick Smith go broke. We've had Woolworths pull out of Masters. So we look at Dick Smith and Masters. They've become known as like big brands in the Australian market. And Dick Smith is gone after what was opened in 1982 by Dick Smith himself. So how do we look at opportunities, and how do we identify what are those opportunities as opposed to those companies that fall in value, not just fall in value, that go broke? So there's a few things that we can do during these uncertain times, and this is the first thing that the majority of investors do. Option one is to stick their head in the sand saying it'll be right. And that's one of the common phrases that we hear from financial planners. They look around and they go, markets go up and down, just stick your head in the sand, you'll be right, take a long-term view. You'll be right, mate. And that's become a problem for a lot of Australians. That's one of the reasons why the majority of Australians fail to reach their retirement goal, is because they're too easily convinced that it'll be right, mate sort of attitude, and they stick their head 6 foot under. Secondly, the other step that people do that is financially crippling for their retirement savings in their future is that they run for the hills. They hit the sell button in a frenzied panic, and they get out of there and go to what is considered a safe haven. So they transfer their money from growth assets and go to cash at the worst possible time. Now, the market has fallen. Like, our market has fallen from close enough to 6,000 points, which was its high last year, to just under 4,800 points now. So technically, a 20% fall is a bear market, a crash, and we've experienced that over the last 12 months. So when people read the headlines, 36 billion wiped off the Australian economy, they hit the sell button, they run for the hills. But they're selling at today's market price, right? They're selling at low prices. When it comes to making money, whether you're investing in shares, property, or any other asset, is you buy when prices are low and you sell when prices are high. So now isn't the time to be hitting the sell button in frenzied panic. It's to reassess your situation and ensure your investment portfolio is invested in accordance to your long-term goals and objectives. So don't do the second biggest mistake that the majority of investors do, that is run for the hills right now. Now's the time to be looking at, well, is there opportunities that you should be taking advantage of? After all, the safe haven, the so-called risk-free investment is in the bank account. And at the moment, the return on money in your self-managed super fund bank account is 1.9%, which is behind that of inflation. So you've got to ask yourself the question, if you do go to cash at the worst possible time, is 1.9% going to reach your retirement goals? If you're achieving 1.9% per annum, I doubt it. We need higher returns than the alternative. So don't go to cash. I think that would be financially devastating for yours and your family's future, certainly in retirement. Third opportunity is to follow those people that have been successful before you. And my number one investor, I'm his number one fan, is Warren Buffett. Warren Buffett's philosophy is the time to buy is when there's blood on the streets. To make money, he says, you be very greedy when everyone else is fearful. And right now, with the level of uncertainty, the noise in the market, there's plenty of people fearful and plenty of people running for the hills, sticking their head in the sand, where if you're looking for opportunities, you could just become one of those few percentage people that actually reach their retirement goals. So let's look at the Australian share market versus the world. So I'm going to compare the Australian share market against all of these economies around the globe, which are meant to be a lot more superior than Australia. In fact, they're not superior. They're in a lot worse situation than our overall economy. But remember the Australian economy. Right now, the government has the ability to implement monetary policy. What monetary policy refers to is the ability to lower interest rates. What our interest rate at the moment at the RBA is at 2%. So if the government need to stimulate spending, they need to stimulate the Australian economy. What the government does, they lower interest rates, more people gain more confidence, they've got more money to spend, they go out and buy more stuff that they probably don't need, irrespective of the dynamics behind what they need and what they don't. It gets a lot more money in the economy. When there's more money in the economy, that flows down to companies' profits, and when it goes to company profits, it increases dividends and eventually increases share prices. In Japan, we have negative interest rates, right? In the United States, it's all but zero, right? The majority of the world have no ability to implement monetary policy. Where here in Australia, we still have bullets left in our monetary policy gun. So that gives me a fair amount of confidence that, hey, if we do have a domestic issue, the government can stimulate the economy. And if you look around, we probably do have an issue. For the last decade or 2 decades, we've been running an economy on a banana republic. It's not necessarily bananas this time, from the famous Keating quote back in the 90s. What we've been doing is relying on digging shit out of the ground and selling it to China. Now that's obviously slowed down. We've seen commodity prices and commodity focused companies share price suffer a lot. However, we need to come up with another solution. The good thing is that if the government needs to stimulate economy, if the slow down the mining sector becomes more systemic than what we think, they can lower interest rates. So if we look at the Australian share market, now this goes back to the pre-GFC high. So the high of the Australian share market was around 7,000 points, just under. So that was back in late 2007, and then the GFC occurred. We saw the Australian share market fall 50%, as can be shown in the chart you're looking at. We then had a little bit of a rebound where we came back a little bit, and over the last 6 or 7 years, the share market's done bugger all. Let's not analyze our share market just yet. Let's compare it to the rest of the world. So this is the FTSE, right? The FTSE at the same time period, marking at the same entry level. We saw the FTSE fall back in 2008, not as far as what the Australian share market did. And it's recovered to be only down 6% from those pre-GFC highs. So it's performed since 2008 a lot better than the Australian share market. This is the Nikkei. This is the Japan index, the Nikkei 225, the largest 225 companies listed on the Japan Stock Exchange. So as you can see, the market fell just as far as the Australian share market did in 2008. And right now, it's basically break even after falling a fair amount in the last few weeks. Again, while we've had a correction in the Nikkei over the last few weeks, it's still a lot better off than the Australian share market over that period. This is a German DAX index, so the German stock exchange. From the pre-GFC high, it's actually up close enough to 20%, despite having a correction over the last few weeks. Again, a lot better performer than the Australian share market. And then finally, this is the purple line, which is the Dow Jones, which is the United States measure of the market. It's up 23% from those pre-GFC highs. If we go from the lows that were experienced in 2008, these share markets have had like a huge bull market. Like it's had one of the best times in the share market that we've witnessed. What hasn't had the best times that we've witnessed in the share market is here domestically in Australia. So what I look for as a investment manager is to look at these charts and the trends, and I love overlaying colorful charts. It looks pretty, and then try to divulge a story around it. But what we need to look at as investment managers is to go, well, okay, where am I going to invest my money? If we're looking for opportunities, where's the best place for my cash to be right now? So the United States looking at lifting interest rates, we're a bit uncertain about that. China's slowing, we're not too sure about what's going on in China. Nikkei, negative interest rates. Right, so you look around the globe, there's not an economy that has the strengths that the Australian economy does have. We're becoming more and more diversified. We've got the ability to lower interest rates if need be by the RBA. So our economy is looking a lot better than the economies around the world. So if we're looking at growth assets, while the share market over the past, 8 years has done bugger all here in Australia, that doesn't mean over the next 8 it's going to do exactly the same. Eventually, I think the Australian share market will catch up to the performance of the rest of the globe. To do that, the Australian share market needs to go up 40-50% just to catch up, let alone growth on top of that. So we recognise that the Australian share market, despite the noise, the current weakness gives us a great buying opportunity. We now need to look at individual sectors within that broader share market as to where we're going to invest our super money. Before we do that, let's look at the strategy. The JBWay investment strategy, which many of you no doubt have already implemented, overcomes the uncertainty that if I am wrong and the Australian share market collapses, let's say China is a bigger problem than what we anticipate. Let's say US increasing interest rates has a bigger effect on the global economy. What we need to do is come up with a risk reduction strategy. That way we don't sit on the sidelines or stick our head in the sand. We're able to be proactive because we know if the market falls and the companies we invest in fall substantially, our risk and our losses are managed and mitigated. So let's have a look at it. The investment philosophy involves buying growth assets. Now, looking at the majority of our clients' investment goals and retirement goals and what they've got in superannuation, you cannot afford for the majority of listeners to go to cash. You need to be exposed to growth assets, and they're predominantly property and shares. Secondly, we need to adopt a focused investment philosophy. What a focused investment philosophy means is to have a large concentrated investment in only a few sectors or a few companies. That's the way Warren Buffett maximizes returns. He waits for great opportunities, and when they come around, he has a big swing at them. He knows by dipping his toe in the water, he's not going to make huge returns. He wants to dive right in. That's a way to make large amounts of profits, and that is to have large bets. He believes that diversification may preserve wealth, but concentration builds wealth, and I agree with him. Finally, to be able to adopt such a focused investment philosophy, to have a large swing during these uncertain terms, we need to come up with a risk reduction strategy, and that is by buying insurance. How we buy insurance on our shares is through what's called a put option. A put option is just like an insurance policy. That is, it gives you the right to sell your shares at an agreed price on or before an expiry date. So if the company goes broke or the share price falls, you sell it at what the protected value is, which would be very close, if not the price that you purchased that stock at. So let's go through that as an example. When we've got the insurance policy and the cost of the put option, we're going to offset some of that cost through future dividend income, hopefully. Now, future dividend income is not a certainty. Companies can cut their dividend or cut it completely, right? But we're trying to choose companies that have a high probability of paying future dividends for the next 12 months or in the future. So if you look at the risk, just to go through this quickly, it's maximum risk of the JBWay is the premium you pay for the put option, right? So if you buy a stock at $10 and the put option costs $1 to sell your shares at $10, the maximum risk is that buck. The other counterparty risk refers to the Australian Clearinghouse. It's a subsidiary of the Australian Stock Exchange. So they guarantee the delivery of the value of the put option, your protected value. And thirdly, the returns are uncertain because they're dictated by the performance of the underlying share. So we can't provide you certainty around the returns, but what we can provide you with absolute certainty is the maximum risk that you're exposed to. Hopefully growth comes because we're buying not just growth assets over the long term, but hopefully we're buying quality companies at very low prices. But just in case we're wrong, we're going to buy a put option, tax protection. So let's look at one of those sectors. One of the sectors that has suffered a fair amount is the banking sector here in Australia. If you go through the issues that we are identified that's affecting the market, at least the media are portraying it, that's affecting the market at the moment, we've got the oil price collapsing, right? That has very little to do with National Australia Bank. In fact, I would say that it's got bugger all, if not zero, influence on the future profit and revenue of National Australia Bank. It's got bugger all. We had issues in the United States, very little impact on the profits and the revenue of National Australia Bank. All right, issues in the Middle East, no impact on National Australia Bank. Issues in the UK, very little impact on National Australia Bank. Now, over the last 2 decades, that has had an impact on National Australia Bank because National Australia Bank had a subsidiary that it owned 100% of called Clydesdale Bank that was completely exposed to the UK market. So if there was a UK issue, then it would plague NAB's revenue and future profit simply because it had a business in that area. Now though, National Australia Bank have sold its Clydesdale assets. So irrespective of what happens in the UK in the future, it has very little impact on National Australia Bank. So what I'm portraying here is that we're looking at the market noise and how it's impacting individual stocks. National Australia Bank share price has fallen from $40 a share to $24.50 today. Right? It's been one of the worst performing companies listed here in Australia over the last 12 months. The banking sector has experienced the same problems, right? Despite the facts of the company being better placed today than where it was 12 months ago. Now, we've talked about the noise in the marketplace. Let's look at that fact. Let's look at the facts by National Australia Bank because it should be the facts that dictate our investment decision, not what a silly person writes in a newspaper. So there's National Australia Bank share price. As you can see, it looks ugly. It's fallen from 40 bucks a share to 24, trading at about 24.50 as we speak. So this National Australia Bank shares going to hit 20 bucks. That was Motley Fool. Look out below, right? Australia's biggest banks in a bear hug. When investors dump banks in a frenzied way, they have recently, is often a sign of deeper economic woes. That's not the case. The reason why the banks were sold off is because the banks in Europe, Credit Suisse, UBS, Deutsche, all had issues over the last few months, and their share prices have fallen below their GFC lows, right? Again, National Australia Bank has no correlation to what happens to those banks in Europe, yet the share prices of NAB has suffered a lot. So when I look at companies to invest in, when I look at investment opportunities, I look at the facts and then make a decision on it rather than being influenced by the noise or speculation. Big Four routed as global banking fears take hold. Big banks push Australian stocks lower. So let's look at the facts. National Australia Bank. CBA last week came out with record half-yearly profit. They made $4.8 billion. Now, if CBA comes out with record profit, National Australia Bank are going to do something very similar. NAB, as I said, the Clydesdale assets in the UK have been a problem for the entire outlook of the firm. They tried to sell it. No one was prepared to buy it. They didn't want to own it, so they spun it off. And many of you that had National Australia Bank shares received Clydesdale shares separately. We gave advice that you should be selling those Clydesdale shares because they're not protected and it's only a small dollar amount in comparison to the overall portfolio. So it's best off to offload it. If you haven't done so already, please send me an email. We'll be able to action that if that's what you'd like to follow. The other issue I have with Clydesdale, if NAB doesn't want it, and they couldn't sell it to anyone else, so no one else wants it. I certainly don't want to hold it as an investor. So our recommendation is to offload it. Now, the other thing that National Australia Bank did in the last 12 months is they raised $5 billion in cash. What that means is its balance sheet looks better today than what it has in the last few decades, if not ever. So the balance sheet's better. They're making record profits. They've sold off their problem assets in the UK. As I said, if we looked at the facts, National Australia Bank today looks in better shape than what it has over the last decade. Yet you look in the last 12 months, the share price is down 40%. To me, that doesn't make sense. When it doesn't make sense, I look at the facts again, and then I make an investment decision. If that is to buy National Australia Bank shares, as it is, I own National Australia Bank shares. It is also to buy a put option just in case I'm wrong. The expected dividend yield at current share prices is 11.8%. So if the company just maintains their dividends from last year, the dividend income is expected to be 11.8% on your investment. Now that's unheard of. You've got a bank over 10%. Why would you have your money in the bank earning 1.9% if you can buy shares and earn 11.8% and get the upside capital growth? Sure, you take on the downside risk. Yet if you adopt the JB way, you mitigate the downside risk, yet you're still exposed to a quality growth asset. So we get all the upside without the downside. For me, that makes a perfect investment. Let's look at the analysis and the numbers. National Australia Bank. So we buy 1,000 shares at $24.30. That should be $24,300. Quick maths. 1,000 shares at $24.30 is $24,300. We buy December 2016, so this gives us the right to sell our shares at $24.30 for the next, 8 months, 10 months. Why we're choosing that date is during that period we're going to be entitled to 2 dividends. The cost of that put option is $3.20. That's $3,200. The maximum risk, if National Australia Bank didn't pay a dividend, which I think would be very unlikely, is $3,200. If it pays a dividend, the expected total dividend income is $2,842. That's if it just maintains that dividend from last year. So let's say I'm wrong. Let's say National Australia Bank falls by another 50% from here and goes to $12. We sell it at $24.30 because we've got the right to do so. We've got that insurance policy. The downside risk is the difference between the dividend income and the cost of the put option. That shortfall is $357. So we're taking $357 risk after we take into account the dividend income, yet we get all the upside. So if the share price goes up, let's say it goes to $30, we're making 20%, and we're risking bugger all. If it goes back to $40, we're making, 60%. And that's just where it was valued last year. So the risk after you take into consideration the dividend, just over 1%, yet you get all the upside capital growth potential from where we are today. Look at the payoff. That's the payoff chart for NAB if it recovers to $30. So you look at $30, it was trading at $39.71 less than a year ago, but let's just say it bounces back to $30. Your initial outlay when you include the value of the put option in the shares is $27,500. At $30, your investment worth 30 grand. You add back the dividend income, $2,842. You've made a 20% return on your investment, while your risk is just 1.3% after they pay that dividend. So if you look at the payoff chart, where the red line is, that is if the company doesn't pay a dividend. If it does pay the dividend, the blue line is pretty close as to a risk-free trade. So pretty good, right? The good thing about the share market where we are today is the market madness, the news, the people hitting the sell button, running for the hills in a frenzy panic, have created a great buying opportunity for a great company that has no problems, that is in better shape than where it was 12 months ago, yet their share price is down 40%. They're the things that make a successful investment. It's not when you sell, it's buying at the right time. Right now, I think it's a pretty good time for NAB, and if I'm wrong, we're going to have that protection in place. Let's look at Woolworths. Woolworths is another company that has suffered from market noise. Not just market noise, but maybe some issues that they have internally. One of those big issues was competing with Coles. Woolworths was the dominant retailer for a long, long time. Then Coles took over as it experienced more growth away from food. They received more growth from liquor, from Bunnings, Officeworks. So what Woolworths did is rather than reinventing the wheel, it just copied someone that was more successful than they were. So they went to liquor, petrol stations, right? They were following the playbook of Coles. And that's caused a lot of problems, not so much with liquor or petrol stations, but more with their handyman stores called Masters. Masters has been an issue for Woolworths ever since they stepped into the space. Rather than highlighting why I think Masters has been an issue, the good news is that they've decided to offload Masters. So they're either going to sell it or shut Masters down. What that does for the future is it stops that cash flow bleed that's suffered and hemorrhaged Woolworths as a company over the last few years. The other thing that Woolworths has done is just change management. They've got the old CEO back, and the CEO is developing his board and team of management to drive the business into the future. So we look like management have got a proven track record. They're getting rid of problem assets, just like National Australia Bank got rid of Clydesdale. Yet their share price has gone from $34 down to 22. That's what creates that buying opportunity. So it's selling Masters, which is good. It's well received by the market. The share price did bounce straight after the announcement that they were offloading Masters. The problem is that we've had global share markets push the share price down ever since. New board, and they're undertaking a business revamp, hiring new management and the old guys that have proven track record back a decade ago. Their strong stable dividend yield is 6.7%. IAG is another stock, again, that has very little exposure overseas. It's NRMA, so it's an insurance company based here in Australia. It raised $500 million last year through a placement to the most successful, not just investor, but insurance investor in the world, Warren Buffett. Warren Buffett, at the annual shareholders conference in Omaha that I attended in May, he was asked a question, what was his best piece of investment advice he ever received? Warren Buffett answered with, to buy an insurance company. The next person stood up and goes, what's the second best advice you've ever received? He said, I just told you. That's how important insurance business is. He said he wouldn't have experienced the success had he not had such a large exposure to insurance companies. If you have a look at the subsidiaries of Berkshire Hathaway, Geico, the largest insurer in the world, is 100% owned by Berkshire Hathaway. So it's not just that he's the most successful investor of all time, he's the most experienced and successful insurance investor of all time. So when he outlays money into IAG, being an insurance company, you bet he's done a fair amount of due diligence and he's comfortable with the outlook of the future. Warren Buffett, so he invested last year. The share price that he paid for those shares was $5.57. Now, a lot of people go, if Warren Buffett's buying something, I'm buying it too, even if I pay higher than Warren Buffett, and that's what the majority of people do, is they pay a premium to what Warren Buffett gets stock at. Here with IAG, though, Warren Buffett paid $5.57, and currently the share price is at $5.11. So you're buying it at a 10% discount to what Buffett paid. Now, that's unheard of. I'm happy to buy whatever Buffett does, especially when it comes to insurance companies, but when I can buy it 10% below what Buffett paid, I'm happy to do that. With a lot of my cash. Now, in addition to the money that it's raised already off Buffett, it's got the capacity, IAG as the company, has got the capacity to sell another $500 million worth of shares to Buffett over the next 2 years. And that share price is above $6 a share. The dividend yield, where we are today, is at 8.1%. I think that's going to be sustainable, certainly due to the cash injection that Buffett provided of 500 mil. So as we can see, Woolworths, IAG, National Australia Bank, all isolated to all the problems that are plaguing the issues around the globe. It's isolated from the problems directly in China. It's isolated from the problems in the United States. They're all isolated from the problems that are in Europe. Their share prices have fallen significantly. Their dividend yield looks quite strong and stable for the future. And they're well above the 1.9% you're going to get in the bank account. For that reason, I'm happy to own the 3 stocks. If you look at IAG and Woolworths, there is a shortfall between the dividend income and the cost of the put option, but that's only a few percent. If you spread your investment across those 3 with protection, that'll give you high growth upside. Yet if we're wrong, and let's say the global market goes to the next GFC and the Australian share market follows, you're only out of pocket a few percent. Because of that downside risk, I don't need to be fearful. I can be greedy, like Warren Buffett says. Be greedy when all others are fearful, and they'll give you the capacity to buy at a very cheap price. When it comes to investment success, it's very, very simple. Buy low, sell high. To do that, though, You got to do the opposite to what everyone else does and opposite to what you read in the market and in the media. So if you look at the media and it says $36 billion wiped off the Australian share market, look around, not in a frenzied panic, but look around where the opportunities arise. For me, those three opportunities are those three that I just explained. So sure, look, there's a lot of things to be uncertain today than what we had yesterday, or was there, right? There's always something to be worried about. You just got to ask yourself the question as to whether or not the market has already factored that uncertainty into price. I think it has. I don't have that crystal ball. I don't know what the share market's going to do tomorrow. I don't know what it's going to do over the next 12 months. I don't know what's going to do over the next 2 or 3 years. But what I can say is in 10 years' time, I think it's going to be a lot higher than where we are today. As a growth asset, if you need growth-like returns, it's a great place to have your self-managed super fund money. But just be mindful, though, if you're investing in the share market, it is risky. Mitigate those risks by buying put options stacked as insurance. That gives you the certainty and the confidence to overcome people's fears or your fears and to be a successful investor. There's the share market. As you can see, it's crashed. It's done bugger all in 10 years. That goes back to 2006. The last 10 years, it's done nothing. So if it stayed at the same level for another 10 years, that means in 20 years, it hasn't moved. The chance of that occurring is very, very slim. So I think the share market is a great place to have a part of your investment portfolio. Certainly if you've got it in protection. There's the United States share market. Remember, the GFC was caused by the US share market and US banks. If you look at the US banks, they're all trading at pretty high levels, a lot higher than what our banks are. Yet, our banking policy is the envy of the world. So that's my view on the share market. Look, to summarize, it's a time to be looking at opportunities, not sticking your head in the sand. Secondly, it's certainly not to run for the hills. It's time to look for great opportunities where the facts look really, really good, but the share price doesn't. It's during those times that you make a lot of money. So let's pass over to questions. I haven't been looking at it because it hasn't come up on my little dashboard. I might see if I can find it and address any questions or concerns that you guys might have. So bear with me, I'll bring it up. Chat questions. I'm looking for questions. There we go. I got it. It looks like I didn't have the question box open. So if you do have any questions, by all means, put them in now, and hopefully I'll address them. One question that I commonly get is, look, what happens if the protected price is below that of the share price? So let's say we buy NAV at $24.30 and we buy a $24 put option. Your right is to sell it at $24, not your purchase price. So it's the protected price, or what's referred to as the strike price of the put option. Hopefully that makes a bit of sense. Dividend income is not certain, but you look at companies. Let's have a look at National Australia Bank, right? The probability of National Australia Bank paying a dividend in the future is highly certain, simply because of the revenue model and the profit model. It's more stable and growing. So when there's stable revenue, stable profits, I'm more confident that dividends are going to be maintained, if not increased. If we go to companies that are exposed to oil and gas right now, oil and gas and highly leveraged companies, let's call it Santos or Woodside, Santos as a focal point. Santos is a problem because they've got a huge level of debt. Their revenue is uncertain because at the current price of the of oil, it's unsustainable for them to drill. Right, so because of that uncertain revenue, uncertain profit, dividend income is uncertain. So if you compare National Australia Bank with stable revenue, stable profits, I'm more confident in that reaching its profits and dividend payout, where Santos probably won't. And that's sort of, you look at where we're investing, IAG, National Australia Bank and Woolworths, they're stable revenue models. So irrespective of what happens to the global economy, I'm pretty confident that they're going to be maintaining that dividend. That dividend is very important because it offset a lot of the cost of the put options, which reduces our risk substantially. Look, some questions about investments. Happy to open up about everything. Berkshire Hathaway. Berkshire Hathaway for the last 6 years, I've launched an investment linked to Berkshire Hathaway. The average return for those that have matured the on-cash return has been just over 100%. So clients have doubled their money over a 3-year holding period, which has been phenomenal. The Berkshire Hathaway share price, if you looked at the A-class shares, has fallen from around $220,000, if we looked at their high last year, down to $193,000, which is where it closed on Friday. So while the rest of the globe have fallen approximately 20%, like the Australian share market, Berkshire Hathaway, being more stable and protected business, is down just on 10%. Question about the current shares that you own. Look, if we looked at National Australia Bank as an example, a lot of our clients own National Australia Bank because it's been a core part of my portfolio for a decade. What we're looking at doing, it depends on the timing and the protected level. Let's say you've received all the dividend income and the protected period is about to lapse. What would be recommending is selling at the high price and buying additional shares at the lower price, which is a process called rolling down. What we've also done, majority of you were given our Christmas present this year, which was a home study program. If you haven't already done so, grab the DVDs out and watch the JB Way component, buying shares the JB Way. It goes through in detail the process of rolling down and when and why we'll do it. It actually covers everything SMSF related, that home study. So we go through what is an SMSF, your compliance obligations, your tax obligations, what we do, what are your responsibilities as a trustee. It goes through insurances, it goes through estate planning, which is a critical component we all need to look at. Then goes through investment strategies like property, shares the JB Way, looks at commodities, so it covers a fair few things. In fact, what I think is everything relating to an SMSF. So please watch it. In the next week, we're going to be uploading those videos onto our library, the SMSF Club Mentoring library, as an induction program. So whenever you need some base information about the fundamental investment strategies we're adopting, everything is in there under that induction program. And you click on individual videos rather than watching 12 hours of content. Jim Rogers investment, the other one was commodities based, which is Jim Rogers. Jim Rogers is interesting where it's got actually 30% exposed to precious metals, predominantly gold. The gold price during these uncertain times is also considered a safe haven. So a few people have moved their cash from growth markets to gold. Doing so, the gold price has gone up. I think it's gone up about 20% from its lows over the last few months. Unfortunately, though, what has caused the global market to be uncertain is oil and other energy-related investments. Now, Jim Rogers has 40% exposure to energy-related commodities, predominantly oil and gas. So because of that, the overall index is down. Like from where it was 12 months ago, it's down around 20%. If you invested in the last issue, it's about the same because we actually implement dollar cost averaging. We will be sending out an update on the Rogers investment in the next few days. The third part is food, soft commodities, and if you look at buying an avocado or buying pork right now, the price of food have gone up. It's quite expensive. So we've seen the majority of the index go up, but unfortunately energy, being oil and gas, have actually fallen. I don't think that's sustainable. Right now I'm actually putting together an oil investment for some professional and sophisticated investors. So I think the oil price can't sustain these low levels for too long. A few other questions for you coming through. If I don't get to your question today, I'll send you an email with a response. If you still own Santos, look, our recommendation, because of the future dividend income being a question mark, I don't think it's going to happen, and the chances of it increasing to above your protected level is slim. My recommendation is to sell your Santos shares at your protected level and reinvesting it into another company that has more stable future revenue and cash flows, like Woolworths or AEG, depending on what you don't own. Look, thank you very much, guys. Look, I hope you gained some information out of this this webinar. If you don't hold any shares and you'd like to, or like to at least consider it, then by all means, send your SMSF advisor an email or email me directly on justin@thesmsfclub.com.au. Happy to provide a few recommendations for you and put together what we've spoken about today into an actual plan. So thanks guys for tuning in. This webinar will go into our mentoring library as well. So in the future, if you want to refer back to it, then by all means, you can access it through the mentoring library. To get to the mentoring library, you go to the SMSF Club website, smsfclub.com, the smsfclub.com.au. Top right-hand corner, it's client login. Click on that. It'll come up password. The password is my-smsf. So capitals my-smsf, and you'll be able to access not just our home study, but also all of our webinars that we've done, the books, the superannuation guides, newsletters. There's plenty of information there for you. So thanks, guys. Happy investing.